Volatility is back. Are you prepared? Lots to talk about in our month-end wrap-up, so stay tuned. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links on today's video. Also, if you find this video of value and are looking for a different opinion, that of Wall Street and Big TV, please do consider subscribing. So let's get to the big chart. Well, not quite yet. Let's hold off for a second because don't forget, I know these videos are confusing sometimes. We created some other videos explaining some of the terminologies, moving averages, RSI, MACD, so take a listen. So getting to those charts, S&P, October, not too good, down over 5%, and this was after a little bit of a push, not unexpected after seeing some really oversold conditions as we closed out the month. Also, don't forget, last day of the month, beginning of the month, we have a lot of rebalancing on the institutional side, so that will also move the markets. One of the reasons I don't like to trade on either of those days. So in looking at this chart, at the bottom, any change? Maybe a little bit. At the very bottom, you see MACD, momentum, trying to turn up. Now, we've had a head fake before, so let's see what happens. I want to see it cross above red before I see true momentum. RSI, yeah, we bounced off 30, which is always a good sign, pointing up. But again, we've done this before, so I'm looking for more confirmation, getting ourselves above 50 on relative strength. Next one, chart we've been showing all year. We are still in the box. Now, at the bottom, volatility. We've been in a range of 15 to 25. That's pretty strong. Remember last year, we were 10 and below, the lowest average in history. That's the difference between last year and this year. So when I see volatility between 15 and 25, I am definitely hesitating. So when I look at this inside the box and where we are today, is it worth the risk to continue to deploy more equities? Well, as you see on the upside, as of yesterday's close, 2.98%. So if you're in a 60-40 portfolio, let's say you might capture 60% of that. Might, because bonds aren't doing too well. So let's say it's 1.5%. Is it worth the risk at this point when you have 4.82 on the downside? I say no. Again, I'm looking for a push up. Can we get above the 200-day moving average? Let me go this way. I forget sometimes. The 200-day moving average, which is moving up, not a good sign. So right now, short-term signals are negative, and I'll bring it all together here in a second, what that means. Next, weekly, S&P weekly. You can see it. We have our trend line from 15-16. We broke it this past month. That is not a good sign. So until we get a resolution there, meaning can we get back above the trend line, I look at that. I look at MACD below. MACD, momentum, really bad. This to me is negative, which is why we've gone from neutral to negative on our midterm view. So here's our monthly view. What do we see that's different? Well, obviously you see the channel, okay? So when we look at this quote-unquote correction from high to low, we did hit about 10%. It is just a correction within the long-term bullish trend, and you can see it right here. Now, what has happened? Talked about this before. At the top of the chart, RSI, relative strength, negative divergence. The other big thing is, if you look, we broke the channel line from 2009. I'll have Michelle zoom in there. That, my friends, is not good. Not good that we broke it. It is good that we held it and ended the month just a little bit above. And then the other concern is at the bottom, MACD, momentum. Look at that. it is not looking good. It has a potential to cross over. So right now, we are still positive on our long-term view. Now, these get confusing, so what I want to do is clean it all up, get rid of the daily noise, and I'm just putting in moving averages. Very simple to see and understand. So you have a 20-day, 30-day, 40-day, 50, and 200-day moving average, meaning the S&P above or below that 20, 30, 40, 50-day moving average. Is it a little bit different from the beginning of the year? Pretty much. When you agree, one is the trend is clearly to the downside. You can see it. The 20-day moving average is hitting the 200. Now, yeah, it's a little bit concerning because we have not had that for quite some time. It's when the 50 goes over that we really get concerned. But again, getting rid of the noise, it does not look good. How about the Nasdaq? Woo! That, my friends, is just not good. Last month, over double-digit in losses. The bottom line is the street is no longer willing to pay a premium for companies that have high PEs, and revenue growth is slowing. So the question I've gotten quite a bit is this different from the beginning of the year? As I like to say from one of my favorite movies, you betcha.
Oh, you betcha, yeah.
Now, take a look. Showing this from the beginning of the year. Again, to repeat ourselves, black line is S&P going up. Looks good. Good trend at the beginning of the year. In the back, the histogram is new highs. So new highs minus new lows. Pretty simple. Strong. The market was surging. Real strong. And then as we got into the fall, a lot of people disagreed with me, but I said there is a problem here. When you look at new highs minus new lows, getting a series of lower highs, never ever good. Yet the market continued to go up. That was not a good sign. That's one of the reasons why I have been saying new client assets, I stayed in cash, and I started to reduce equities as I went into the fourth quarter. And then you look at the red there, new highs minus new lows. Again, really bad looking. Does it look different? Sure, right? It's much longer picture that we've been in this bad pattern. So the next one is moving averages. Showed this in the last video. Is it different? Yeah, I think a couple things. Here's your 50-day moving average, S&P at the top, Nasdaq, mids, and smalls. The difference is, again, we're in a longer period of being below that 40. So in the short term, below 40 is bearish, above 60 is bullish. Now, you can see some price swings on a 50-day. On a 200, it should be smoother. So is it different? Again, absolutely. When you look at where we are in the S&P, just holding on to 40 at 40.8 to close out the month, but we have been below. When you look at the Nasdaq, below 40. Mids and smalls, 30 and 31%. Looks extremely different because in no scenario did we break below 40. Now, the other thing that's different is at the beginning of the year, we saw a surge, of course, and then we started going down. Now, on this chart, I have the German DAX, I have emerging markets, and I have China. We continued to go up, and they continued to go down. So this global synchronization makes it different from the beginning of the year as well. So, next up, wrapping up this section, U.S. equities, 0 of 11 in an uptrend. So, of course, as a group, we're in a downtrend. International, 2 of 3 in an uptrend, down from 3 2 weeks ago. So, of course, we're down. So, what does this all mean to our clients and anyone else? Well, we have negative signals on short and midterm. So, right now, we're about 15% cash, 30% in equities, and then we have a hedge position in there as well. So we're really kind of very much neutral right now, have the cash for a little bit of protection, but if we have a jump, we have an opportunity to deploy. Next up, tweets of the week. So a couple things here real quick. Real Vision, Stanley Druckenmiller, one of the all-time great investors. article here. I think it's worth the read for those people who really enjoy the markets. We have a link below. Next up, David Rosenberg, one of our good follows. Yellen and Powell are on the same page when they're looking at leveraged loans. Hello, at $1.3 trillion. There's a lot of firms that could go bankrupt. We will continue to watch that. Next, one of my favorite followers on Twitter, meaning I follow her, Danielle Martina Booth. I talk about her book, Fed Up, great book, worth the read. We'll have a link below as well. Now, U.S. economy flashes signs it's downhill from here. Again, I'll have a link to the market here. So this all comes together and says that we're slowing. And this explains, for the next section, what keeps me up at night. Well, here you go. Great looking chart here, but is it a good time to invest? This shows 9 straight quarters of GDP growth. That is great. But I think, not just I, other folks think that we have peaked. And that's a concern. And we're seeing it already from last Friday's numbers, future numbers for fourth quarter. So GDP peaking is an issue when you can take a look here. Here's one of the research firms that I use, Hedgeye, and what their projections are, and you can see how the peak and how we start going lower. And this coincides with the reason why we were down last month. When companies got hit, revenue miss, revenue guidance was moved to the downside. That is called slowing, okay? Next up, peak housing. You can see it right here. We're definitely seeing signs of that as well. And then here was earnings. Look, yeah, we've had a great quarter on earnings. So far, 240 companies through the other day. Again, comes from Hedgeye. But again, we feel that we've peaked. Why? Well, if you're up here with earnings and revenue projections are to the downside, that's an issue. Hey, if you're a Wealth and Wisdom viewer, not a client, or looking for a financial plan, don't forget we have a special financial plan for you. There's a link below if you'd like to check out for more information. So next up, Treasuries. At the beginning of the year, I called this the most important chart of 2018.
And I was right.
We have broken out of a 30-year trend line, so rising rates. Now, what does it all mean? Well, a couple things. Right now, came down to 3.08 the other day. I'm still in the camp. We have a chance to go lower, maybe to the 3, maybe even break 3, especially with this volatility, but clearly we're in a trend. Now, next we have 10 minus 2s. 10-year Treasury minus 2 years, okay? And when you look here, we're back down to about 0.28. So what does that mean to you? Again, this is a recession indicator for us. Every time in history we have inverted, gone below 0, okay, that has indicated a recession is coming sometime in the near future. Let's get close to wrap things up on my radar. Well, as you can imagine, not a lot, but what about the shift I've been talking about? So first up, utilities. Is this a good buy? You look at this, first off, lots of volatility on a daily basis. You're kind of just meandering along there as well. We're not seeing a clear breakout. So then the question is, how does it compare to the S&P? What we do is with our charting program, utilities relative to the S&P, right? And you can see at the end, I always get confused. You can see at the end of the chart there, it is trying to break out, okay? But it's coming back to that trend line. So I'm looking for a bigger breakout before I look to that. Next up, consumer staples. So what do we see here? A little bit better looking chart, okay? When I see this, a series of higher highs, you have a golden cross, 50-day going over 200-day moving average, setting up nicely right now. Now, same thing, consumer staples relative to the S&P. Is it worth it? Well, right now, there's my line in the sand. If we can break above that, then I will look to add this in the next couple weeks. Wrapping things up, fear and greed. We are down to a scary 7, down from 11. Obviously, that's concerning. So wrapping it up again on the signals. Short-term negative, midterm negative, long-term is still positive and just holding on. Thanks so much for watching. This is Michael Loftus for Wealth and Wisdom TV.